So receiving restricted stock units from AT&T might feel like free money. However, if you don't know how to manage them correctly, you might be in for an unpleasant surprise come tax time. That being said, using restricted stock units can be a very powerful wealth building tool as long as you know how to manage them correctly and use them to your advantage. So today I'm going to talk to you a little bit about restricted stock units that you receive from AT&T, how and when they vest, and then also the tax implications that come with restricted stock units. So what are RSUs, or restricted stock units? Well, they're essentially a form of equity compensation that AT&T gives you during the bonus period in addition to the cash that you receive. So think of it as a promise to deliver shares to you at a future date. And that future date is actually what's known as your vesting date. And we'll get into that in a little bit, understanding some of the key differences. So when you actually receive your restricted stock units at AT&T, well, you really need to know the difference between two key dates, and that's the grant date and the vesting date. So the grant date is actually when AT&T gives you the restricted stock units. The vesting date is actually when those restricted stock units vest. And there's a difference of time between the grant date and the vesting date. And for you at AT&T, that's a time period of 3 years. So 3 years has to go by between the grant date and the vesting date. Now this is where things get tricky, because a lot of AT&T employees don't actually understand how restricted stock units are taxed. And to be clear, you're actually not taxed on your restricted stock units until they actually vest. And when they vest, you're actually going to be taxed at the ordinary income rate. So basically think of it as the fair market value of those shares on the vesting date is what will be treated as ordinary income for you as a recipient of those restricted stock units. Now, if you decide to hold on to those shares and sell them at a future date, then, and if there's a gain on those shares, then you'll be taxed at either an ordinary income rate based on that gain if you held them less than a year, or if it's over a year, then you will pay a long-term capital gain on those shares. So it'll either be 0, 15, or 20% depending on your taxable gain rate. So again, those shares that you receive on the vesting date will have a basis based on the fair market value of those shares. When you sell those at a future date, if there's a gain, the difference between those shares prices at that future date versus the basis or that fair market value on the vesting date will be that gain. So I know there's a few nuances there, but again, important things to be aware of from a tax standpoint as you think about your own tax situation. If you still have questions, feel free to drop them in the comments. Thank you for joining the video today. I look forward to seeing you in the next one.